I'm Lucas, your host for the Finance for Others podcast and a junior at Strike Jesuit. I realize that many students often graduate with limited financial knowledge. So I started Finance for Others to help bridge the gap in financial literacy. Joining us today is Pablo Vivas, a finance expert with over 20 years of experience. Wait, wait.
Dale, para que yo saco el...
Joining us today is Pablo Vivas, a finance expert with over 20 years of experience and an MBA from Ross Business School. Before we get to the financial questions, I'd like to ask you, Pablo, if you could tell us a little bit more about your background.
Yeah, sure, Lucas. Thanks for giving me the chance to share some thoughts with you on this podcast. And congrats for the initiative, and I appreciate you thinking about me as being a participant. So, a little bit of my background. I grew up in Argentina, which is a very volatile economy, and from a very young age, it exposes you to things that not a lot of kids are used to when living in other countries because we've been through so many financial crises, and it's inevitable that you learn how to manage your money at a very young stage of your life. Things get a little bit crazy, so that drew my attention into finance as a career. So my background is in business administration with a focus on finance. My first job was at a bank. I worked at a research department, which is, you can think about that as a think tank where there's analysts taking a look at not only fixed income, but also variable income, which is stocks. So you look at bonds and stocks, and you learn how those instruments are valued, and you pretty much are focused on both fundamental and technical analysis. So that was very useful. After that, I pursue an MBA. So as you said, a couple of years in Michigan, at Michigan Business School in Ann Arbor. And after that, I jumped over from the banking sector into the oil and gas sector. And I became a frontline trader of commodities, both products coming out of the refinery and the crude oil coming into refineries. And that's what I've been doing over the last 15 years.
Thank you very much for sharing your background and experience. Um, that was very insightful. And now to kick the podcast off, I would like to ask the first question. What's the most important lesson for young people about money?
Yep. As my first boss at the bank would say, money shouldn't be the first concern, but it shouldn't be the last concern either, right? So money gives you basically financial freedom, and for some people that may mean gaining confidence in terms of making decisions, right? And for some other people, may be a little bit more problematic, right? Because the more money you save or the more money you have, some people are very disciplined about it, and some people need a little bit of help in terms of managing it, right? So, in terms of advice, I would say that think about money in terms of an opportunity, right? To let you decide what you want to do in life, and also smart investing. So if you enjoy that, get involved and do it. Take action and be on top because it could be rewarding.
Okay. Yeah, thank you very much for that advice, Pablo. And now imagine you have a time machine and could go back in time to when you were a high school student. What would be some financial advice you would give to your high school self?
Yep. When you're in high school, right? Um, Basically, either you get supported by your parents or you have your first job and start saving a little bit of money, right? I think that's very important because at that stage of your career, you got to learn those steps of initial steps of what it means to have a bank that comes with some responsibilities, right? Just basic stuff as you want to spend what you have. Don't go beyond that because that could create some stress and tensions with the financial institution. So, building some reputation that would allow others to trust on you is something that at early stages is very important. Again, I talked about discipline, and that is something that you carry over your entire life. And if people trust you, then you can improve your credit score, be seen as someone that can potentially borrow money from others. And if you do that and you invest wisely, that is what can cause some leverage in your portfolio, right? And that is where potentially the bigger upside for someone in terms of personal so don't shutting up with the things that are basic, such as your own reputation as an individual investor. Okay.
Okay, yeah, that's definitely really good advice. Like especially about like the credit score because that's definitely really important to make sure that you have a good reputation. And now, um, I would like to talk about savings. How important do you think savings are?
Saving is very important. Um, if you know how to manage your savings right, as I said before, it gives you a little bit of confidence in terms of feeling that you have the freedom to approach several investment options, right? Savings um, is kind of basic, Lucas, because sometimes if you don't save, for example, you're not going to have that upfront money available to put a down payment to buy a house. Um, if you don't save, you won't be able to buy your first car, right? I mean, the US as a country is exceptional in terms of having access to loans, having access to bill debt. But the core fundamental of personal finances is sitting on personal wealth, and that comes with savings. And we, I grew up in a country that maybe was skewed towards financial assets, seeing financial assets a little bit differently, right? In the US, and especially at your age and with the technology that we have now, having savings and open that first stock account, for example, right, can help you start getting yourself educated in terms of buying stocks, buying fixed income, doing a broad set of things that can help build that financial knowledge that you need.
Yeah, definitely, yeah. I really like that advice. And since like you mentioned like investing, which goes like in hand with savings, what are some recommendations for young people concerning investment?
All right, that's a very. I mean, I'm going to answer that with a personal touch, right? Because you have I mean, every person will have a different answer, and I think it's very important to know yourself and what's your risk appetite. So there's not everyone's built or has the same look about the volatility that you have in stocks. Some people, I mean, when markets go up and you're making money, everyone's happy, right? But if you're invested in stocks and there's a bad day and you lose a lot of money, if that makes you feel horrible, right, and you're not enjoying it, then maybe that's something that is not for you. If you have the risk appetite to transition those ups and downs and you're there for the long term because you're at early stage of your career, excellent, go for it. And then the advice would be naturally kids get have a tendency to get involved in stocks. I think that there's a broad range of investment instruments beyond stocks, such as corporate bonds, sovereign bonds, even options, or again, real estate investments, buying a house, investing in cars, gold, commodities, right?
Yeah.
Uh, Learn about those. I mean, remain curious, right? be creative, right? Jump onto stuff that makes you feel also uncomfortable and see whether that's the right thing for you or not. That is, especially for the young kids, that's quite key as you start developing core financial investment knowledge.
Yeah, yeah, that's really good advice. Yeah. Um, I especially like how you talked about like how like we should like how we should like hunger for knowledge and learning about new things and getting possibly out of our comfort zone. And also now I'd like to switch gears and talk about your experience at Ross. What is the most valuable lesson that you learned at Ross Business School about personal finance?
Yeah, one of the things, and we touched on it, is understand what you're investing in. So personally, I don't invest in Bitcoin. Why? Because I don't understand the fundamentals. And there's two types of analysis, right? And this is something that I learned in the business school: fundamental and technical. With my bank experience, I was very focused on fundamentals, which is supply and demand, for example, right? Um, Microeconomics, macroeconomics. That was my forte, right? That was what I um, what I knew. I mean, how to do, right? If you go beyond fundamentals, there's also a toolkit of technical analysis that helps you understand market momentum and cycles in the market and upward or downward trend, resistance and pivotal points, right? Those and there's a lot of technical skills that have been developed throughout many years, right? And there's a lot of literature about it, right? So I've been exposed for my first time to that type of analysis. And when you complement both fundamental and technical analysis, as an investor, it gives you much more confidence. So I think reading about not only fundamental but technical analysis is something that came pretty handy and useful as an outcome from my experience at Ross Business School.
Hmm. Yeah, it's definitely yeah, it's really important, I would say, for investment. Because because if you disregard like the fundamentals, and and you just like invest, for example, like in a stock just because of the hype, then that could almost be like considered as like a as like a gamble. Um, Especially if you're just day trading. Because like a
Mhm.
lot of people, like a lot of high school students today, they just like do day trading. And I'd like to ask you what do you think about day trading?
Yep. I mean, um, having a fundamental view on what you're investing will, like as I said, it will give you a lot of confidence, right? Understanding what you're investing in. If there's a bad day in the market, trying to figure out what caused it, right? And then trying to anticipate what's the fair value of the instrument that you're trading, right? Uh, I would also suggest or advise people at your age get together in groups, right, and share ideas, right. That would only help you become better at what you're doing, right. Get yourself. I mean, speak up and have others listen to what your thoughts are, and be welcoming of challenges, right. There's not a right or wrong views, right? As long as the world studied. And if someone, I mean, you don't want to miss a trade or a trick or be blind to something that you haven't looked at. So that collective interchange of ideas always becomes handy and helps you get better.
Yeah, yeah. I really like that because like you portray like a financial journey, like instead of just like as a solo journey, but as like a team, as a like as a as like yeah, a team, like a brotherhood.
Yep. And Lucas, anyone can punt the screen, right? I mean, the stock market is black or white, right? It can go up or it can go down, right? I mean, if you think about it, you may have 50% chances of getting it right. But investing smartly goes beyond that, right? And it just encompasses all the stuff that we've been talking about.
Yes, definitely. Um, and another key aspect of personal finance is budgeting. How important do you think budgeting is and why?
I think budgeting is important, and as I brought up before, it's about being disciplined. It's about forecasting. It's about making sure you things you put some thought around the ins and outs, right? I mean, it's very accounting mindset where you will make an effort, right, to make sure you're not missing stuff out, and there you minimize the chances of having surprises, right? And when you put that mindset in place and you start working through those different aspects of your finances, then you start learning. You start learning about things that you haven't thought of. You start learning about the what ifs. It comes, I mean, the first stage is budgeting, but then it's scenario planning, right? And you're playing around with the assumptions in your model, right? Or whatever spreadsheet or whatever app you're using, right? And when you start working with those levers, right, then you become much smarter because you start working around boundaries, right? And you stress test a model and you go far to one side and you understand, okay, if this is going really wrong, right? Let's say, for example, interest rates are going up and I signed up for a floating interest rate loan. All right. How would that affect my cash flow? And that means that what I have to pay every month on that loan is going to go up. Okay, maybe it goes up by $30. So if it goes up for $30, how does that impact my overall portfolio, right? And that makes you very strategic, right? And gets you prepared. So I think it's something that everyone should have in place.
Yes, 100%. And at a young age, what should the philosophy be on spending, especially for expensive items such as cars and houses? Should it be used, um, should it be a used car or a luxury one? And what is the best in the long term and why?
All right, that's a very difficult question to answer, Lucas, because it mixes up a little bit. I mean, again, personal biases with discipline investment, right? So there's two ways to answer that, right? Um, there's this the utility. There's a concept of utility, which means how much each person perceives as a benefit owning an asset. So if we have Lucas here, that his dream and his ambition was always um, have a motorboat and go to a lake with friends and wakeboard, and that gives Lucas an extremely high utility, right? Meaning that it makes you very happy. Maybe Lucas needs that. Now, at the same time, I could say, hey, Lucas, if you spend on, I mean, that may be considered a luxury item, right? Rather than spending all your savings on something that you could live without, perhaps you save at an early stage, right? You build up wealth and you start spending in those type of assets later on in life. There's not a right or wrong answer, Lucas, when it comes to personal spending. Each one of us has its own biases. What I would say is to focus on things that make you happy. Saving is okay and is critical, but it shouldn't be the ultimate goal, because if you save your life and you never spend, then you're not using the money wisely either. Because one day you're going to be 80 years old, you're going to be craving to wakeboard with your friends, but your body won't be ready for that, right? And you're going to be missing out. So there's a trade off there, right? And it's a very difficult thing to balance. But to answer your question shortly, saving is very important, and I'm a believer that spending less than what you make is critical to building financial independence in the long run.
Okay. Yeah, that was very insightful advice. Thank you very much. Um and to close off and to conclude the podcast, in your experience, how did the purpose or meaning of money change throughout your life?
Um, yeah, I yeah, I mean, I think age is an important factor in terms of how you go about spending, right? Um, I think um, early on you wanna maximize the potential, and again, according to your risk appetite, you're there for the long term, right? So the way you will see money is there's so much life ahead of you that it always gives you another chance to recover, right? So if you're gonna panic and you're gonna take a loss and don't come back into the market, that's pretty bad, Lucas. I think there's enough analysis um, that shows and concludes that it's more important to be in the market on the bad days than losing on the big win days. So if you have money and you're just gonna panic when the market loses and you come out and you miss out the big days, the big positive days, then that's not a wise way of going about investments. So early on in your career, think long term, think a little bit more risk appetite, think that about risk reward, right? If you take more risk, more reward is expected, right? Through when as life goes on, right? Um, you're losing that long-term aspect, right? Because um, by the time you die, right? I mean, if you're like you depend on your savings when you retire, right? You may not have that ability to stay there for a long term anymore, right? So I guess if you see it from a standpoint of a portfolio, right, I would um, err on the side of having larger share of stocks early on and more exposed to volatile instruments. And as life goes on, you reshape that portfolio to look at instruments that are more um, less volatile, right? They move less, they have lower returns, but if there's a market crash, right, um, it's gonna protect you from the downside.
Yeah. Thank you very much for that advice. Today's podcast showed us that many like financial questions often don't have a right or wrong answer and are often like dependent on the individual's taste and preferences. Um and Pablo, thank you so much for taking the time to share your thoughts and advice. To the listeners, um if you learned anything valuable in in this episode, please share it to someone who could benefit. Thanks for tuning in, and we'll see you in the next episode of Finance for Others.